Government budgets and fiscal policy. So today we'll talk about government spending, taxation, the federal deficit, and the national debt, using fiscal policy to fight recessions, unemployment, and inflation. We'll spend a small amount of time on automatic stabilizers, practical problems with discretionary fiscal policy, and the question of a balanced budget. Yellowstone Park is one of many national parks forced to close operations during the government shutdown of 2013, 2018, 2019. So it does have a real impact on citizens when fiscal policy is not appropriately um, taken care of by our legislators. So, what are budget deficits? So, when the federal government spends more money than it receives in taxes in a given year. What is a budget surplus? That's when the government receives more money in taxes than it spends in a year. And what is balanced budget? That's when government spending and taxes are equal. If you Google debt clock, you'll see that we're almost $33 trillion in the red. So we run a budget deficit of about $33 trillion, meaning as a government, we spend more than we collect in taxes. By state statute, so the state of Texas, by state statute, most states uh, are governed by a balanced budget amendment. So each year or each fiscal year, their spending and taxation have to balance, they have to be equal. Okay, so what are some of the major federal spending categories? For us in this country, it is national defense, Social Security, Medicare health programs, public health programs, not private, and interest payments on the debt are the four main categories of spending in this country. Here is a graphical representation from 1960 to about 2020. You look at total federal spending, and then you look at the different things that we spend on. National defense being the greatest, social programs being the second, net interest or interest on the debt being the third. I think by today's calculation, that may be our number one challenge is the net interest on our debt. The deficit is not debt. The government deficit or surplus refers to what happens with the federal government budget each year. I think the last time we had a budget surplus was during the Clinton administration, and that was in early 2000. That was the last time we had a surplus. The government debt is accumulated over time, and it's the sum of all past deficits and surpluses. Again, we run a current budget deficit, if you look at the debt clock, of around $33 trillion in debt. Again, about 60% of government spending goes to these four areas: national defense, Social Security, health care, and interest payments on past borrowing. This leaves about 40% of federal spending for all other functions of the U.S. government. Again, state and local spending. The majority of state and local spending is on education, K through 12, and that is paid for by property taxes in most states. So if you look at taxation, so what are the different taxations that are levied in on the federal side. You've got federal tax receipt. I think each of us, when you start working, you'll file a 1040 or 1040 EZ. Corporations, they pay taxes. Payroll taxes are taken out of your paycheck. Medicare, Social Security, excise taxes, and then corporate income taxes. Those are the major taxation levies in the United States. This is just a definition of it. Individual income tax, a tax based on income of all forms received by individuals. We have payroll taxes, a tax based on pay received from employers. These taxes provide funds for Social Security, Medicare. Progressive tax, a tax that collects a greater share of income from those with high incomes than from those with lower incomes. In the US, we have a progressive tax system where in that lower income folks pay the less percentage of taxes, where high income folks pay a larger percentage. A fun fact, as we talk about progressive tax, 1% of the population, the top 1% of wage earners in the U.S. pays 40% of all taxes, and then the remainder of us pay the remaining 60%. So that's 99% of us. We do have a marginal tax rate system, which is a tax rate an individual would pay on one additional dollar of income. The tax percentage on the last dollar earned currently ranges from 10% to 35%. So here in this example of a marginal tax rate from 0 to 9,000, you're taxed at 10%. Above 9,000, right below 37,000, you're taxed at 15%. Above 36, 37,000, you're taxed at 25%. These are marginal tax brackets. As your income level rises and you hit individual income brackets, your taxation on that income in the next bracket is higher than the bracket before. We have proportional tax is a tax that is a flat percentage of income earned regardless of the level of income. Unlike a progressive tax, a regressive tax is a tax in which people with higher incomes pay a smaller share of their income tax. We are in a progressive tax structure in the United States, not a regressive tax structure. Corporate income tax is a tax imposed on corporate profits. We have excise taxes. We have taxes on gasoline, tobacco, alcohol. Estate and gift tax, which are taxes on people who pass away, their assets to the next generation, either after death or during life in the form of gifts. Again, state and local, within the state of Texas, revenue is generated by the Texas government by sales taxes, property taxes, revenue passed along from the federal government, personal and corporate income taxes. So there are some states out there, maybe some of you in this class live in a state that has a income tax, and then a variety of fees and charges. So if you get your driver's license renewed, you'll see charges for that. That's a good example. Again, state and local taxes have increased to match the rise in state and local spending. This is a graphical presentation of that, looking from 1960 to 2018. So the annual budget deficit or surplus is the difference between the tax revenue collected and the spending for the fiscal year. So most fiscal years for the federal government starts on October 1st, ends on September 30th of each year. The budget deficit refers to how much the government has borrowed in one particular year. The national debt is the total accumulated amount the government has borrowed over time and not yet paid back. So looking at the debt clock, that'll give you an indication of what the country's national debt is. How much do we owe? Again, the federal budget has run budget deficits for decades. Again, you can see that spike in the 2000s where we did run a brief surplus under the Clinton administration. And this is just the sum of the federal deficit and sum of the federal debt is the sum of annual budget deficits and surpluses. Uh, Annual deficits do not always mean that the debt ratio is rising, but you'll notice through 1970 to present, we do have a rising debt level. Again, one of the major challenges here that's illustrated by this graph is you could see total spending has increased exponentially, whereas tax receipts are trending downward. And so when you have that, that's exacerbates your debt. That creates your budget deficits. So it has to be reckoned with at some point. So either we have to reduce spending or increase the level of taxation or tax receipts. So fiscal policy is the use of government spending and tax policy to influence the path of the economy over time. What we've had throughout our history is from the fiscal side, which comes from Congress and the White House, we've had either expansionary fiscal policy. So if the economy was sluggish or slow, that's fiscal policy that increases the level of aggregate demand, either through increases in government spending or cuts in taxes. If we had an economy that was slow or sluggish, then we would have contractionary fiscal policy. That's fiscal policy that decreases the level of aggregate demand, either through cuts in spending or increases in taxation. In this well-functioning economy, each year aggregate supply, aggregate demand shift to the right, so the economy proceeds to equilibrium as always. Each year the economy produces at its potential GDP with only a small inflationary increase in the price level. We kind of touched on that last chapter when we talked about aggregate supply, aggregate demand, potential GDP, and price level. What price level does whether price levels are increasing or decreasing, how it has effect on aggregate supply, aggregate demand, and potential GDP. If aggregate demand does not smoothly shift to the right and matches increases in aggregate supply, growth will, with deflation, can develop. Again, this is another graphical illustration of expansionary fiscal policy where we're trying to shift. We're in this example, we're shifting aggregate demand to the right. So the original equilibrium represents a recession occurring at the quantity of output below potential GDP. If we can shift aggregate demand to the right, enacted through an expansionary fiscal policy, we can move the economy, increase potential GDP, as illustrated by the long run average cost curve. Since the economy was originally producing below potential, Any inflationary increases in the price level should be relatively small in this particular scenario. And this is just the opposite of what I just talked about, looking at contractionary fiscal policy. So the extremely high level of aggregate demand will generate inflationary increases in the price level. A contractionary fiscal policy shift of aggregate demand to the left from AD0 to AD1, leading to a new equilibrium quantity, which also occurs at its potential GDP. Uh, Rarely do we see contractionary fiscal policy in effect. The majority of the time we see fiscal policy come into effect is if the economy is slow, sluggish, in a recession, we want to spur aggregate demand, then you'll see fiscal policy instituted, hopefully shifting aggregate demand to the right and also increasing potential GDP and output. Just from a definition standpoint, talking about discretionary fiscal policy, the government passes a new law that explicitly changes overall tax or spending levels with the intent of influencing the level of economic activity. For example, the 2009 stimulus package is an example. During COVID, there was a lot of discretionary fiscal policy spending in order to bring the economy back because we shut the economy down. What are automatic stabilizers? Those are tax and spending rules that have the effect of slowing down the rate of decrease in aggregate demand when the economy slows down and restraining aggregate demand when the economy speeds up without any additional change in legislation. Those examples are unemployment insurance. If you're unemployed but still looking for work, you can get unemployment insurance. If you also meet income qualifications, you can also get food stamps and other programs that can help your family through difficult times. A standardized employment budget is the budget deficit or surplus in any given year adjusted for what it would have been if the economy were producing at potential GDP. If people who look for work were finding jobs and businesses were making normal profit, it eliminates the impact of economic stabilizers. So, and if the economy is ripping and roaring, um, uh, the need for automated stabilizers is minimized in our economy. Again, this is just an example of the booms and busts in the economy. You'll see when the economy is in a recession, the standard employment budget deficit is less than the actual deficit because the economy is below its potential, and the stabilizers are reducing taxes and increasing spending. Again, the same here is when the economy is performing extremely well. The standard employment deficit or surplus is higher than the actual budget deficit or surplus because the economy is producing at potential GDP, so that automatic stabilizers are increasing taxes and reducing the need for government spending. And that's what you want. That's the key. So fiscal policy and monetary policy, which I've talked about, are interconnected. So, where government borrowing and spending results in higher interest rates, this reduces business investment and household consumption. And so, what we mean by crowding out is if government borrowing, so to buy treasuries that the government uses to fund the debt, are say at 10% interest, and bonds of Microsoft are at 5% interest, then investors will invest in the government 10% bonds, not the 5% bonds. That's crowding out investment for the private sector. And that's just what that term means. And this is just an example of fiscal policy and crowding out. I think my explanation is a good explanation for you as a layman student to understand what does the term crowding out mean. Uh, so fiscal policy either has recognition lags. So when Congress enacts legislation to increase spending in times of recession or economic slowdown, there is a recognition lag, the time it takes to determine that a recession has occurred. There's legislative lag. So the Congress and the White House have identified slowdowns in the economy. They pass legislation. The legislation has to go all the way through the Congress, the Senate, then to the White House. So that's a legislative lag, and then it has to be implemented. So that's the time the legislation has been signed into law, and it needs to be implemented by the different agencies that are that should be implementing that particular program. And that's it. That is fiscal policy. So thank you very much. Thanks for your time.